Okay, so let's change gears a little bit. Let's look at another model. Now, this model should look very similar to what we've just been discussing with the free cash flow model. This is the dividend model, the constant dividend model, constant growth model. So if you look, our formula is very similar. We're going to calculate present value of all future dividends. Again, that's very difficult to do, obviously. So we want to simplify that algebraically. So we end up with a formula. Again, if they're going to grow at a constant rate, we can calculate a dividend any time in the future. So what's the present value of a constant growth dividend when it's discounted at the stock's required rate of return, R sub S? So let's just move forward to the next slide here. See, so the present value, again, D2 divided by 1 plus R sub S. How do you find DT, any dividend in the future? You take today's dividend, you multiply 1 plus G sub L, the growth rate to the Tth subscript. Then you divide that by 1 plus R sub S, again, to the Tth power. This is just a present value of all the future dividends from here to eternity. So, to infinity, I'm sorry. D0 then, multiplied by this factor, lets us know about values, right? How can the company grow? Well, if the growth rate grows, right, the value of the company grows. If R sub S, the required return for the investment, if that grows, increases, the value decreases. And of course, if T increases, we also get a higher value. So again, if G sub L is greater than R sub S, then this factor will be greater than 1. So the bracket approaches 0 as this gets very, very large. Excuse me, it'll be less than 1. So what this means is, the farther out you go, the less value is attributed to those future cash flows. That's exactly what we talk about in the time value of money. So this just applies that concept. So our formula to find the value today of a stock, D sub 0 times 1 plus the growth rate, next year's dividend, divided by the difference between R sub S and the growth rate of dividends. So what is R sub S? R sub S is the required return for investing in this particular stock. Now what we know is that G sub L, the growth rate, has to be less than the required return, or this thing turns negative and we can't have negative prices. So again, what happens if it's greater than that? Again, without getting into too much detail, it just gives us a position where you just can't calculate the number. So the value would be infinity, which of course we can't have that. So again, it has to be less than that required return so that we could use this model. Does that mean that the growth rate of dividends will never be greater than the required return on the stock? Absolutely not. It just means that if it is, this model won't work. So let's talk about how do you find the required return. We've talked about this in other videos. We know the R sub S, the required return on the stock, comes from our security market line formula. It's the risk-free rate plus the risk premium times beta. So in this case, we end up with the required return for this stock, beta of 1.2, risk-free rate 7, return in the market 5 is 13%. So here's a quick question. What is the average rate of return on the stock market then? If the risk premium is 5% and the risk-free rate is 7%, then the stock market must have an average rate of return here of roughly 12%. How do we estimate the value? Plug the numbers into the formula. So we have $2 times 1.06 divided by 0.13 minus 0.06. We end up with a value of this stock of $30.29. So what's the expected stock price in 1 year? Well, what's D2? D2 is D1 times 1 plus the growth rate. So just expanding this formula now, you expect the dividend at the end of year 2, or during year 2, to be $2 and roughly 25 cents. Again, divide that by the difference of required return and the growth rate. The stock price at the end of the first year, we would expect that to be $32.10. What are the capital gains then? So the dividend yield is the dividend divided by the price. So we have $2.12 divided by that price. The value we determined is $30.29. That's the current value. So dividend growth is 7%. Now, what's the capital gains yield? So it's $32 at the end of the year. You start at $30. That's 6%. So the total growth of this stock, we would expect to be the dividend yield plus the capital gains yield, or it should be 13%. And again, just putting this all together in one stock. So for a constant growth stock, the capital gains yield, 6%, is what we expect to be G. So the value of a stock is the dividend yield plus growth rate. Dividends, what you get paid every year. Capital gains is what we get for price appreciation. We can rearrange this model and solve for return. So here's our model, right? R sub S then is going to be equal to dividend yield, D1 divided by P0 plus growth rate. You see, just by manipulating the formula, we can solve for what is the required return on this stock, or the return we expect to get is 13%. Now, can we put this in a worksheet? Of course we can. So there is a stock valuation worksheet inside the stock valuation workbook that has many of these models. But here's where we can put in the data for our models. 13% is the required return on the stock. How do we get that? 7% is the risk-free rate, 12% is the bond, 1.2 is the beta. That gave us that required return of 13%. 6% is the growth rate that we were given, because we know that 13% is the required return. The dividend growth rate is 7%. We calculated that. So that must mean the capital gains is 6%. That's G. The dividend that we started with is this $2 dividend. So D sub 0 is $2. That means D1 is going to be $2.12. So the value of this stock is $30.29. If you paid $30.29, you would earn 13% is the rate of return you would expect to earn on average if you held this investment. So, how do we find these variables? We've already talked about how you find the required return. Now let's talk about how do we find the growth rate of future dividends. There's two basic ways. We can use the time value of money method. We can look at the historical record of dividends and calculate that growth rate historically. Now that's not the growth rate that we want. We want the growth rate of future dividends. So we're going to have to adjust this growth rate for any new information we may have about the company. If the if we calculate the historical growth rate is 6%, I would doubt that we would say, well, maybe it's going to be 12%, or maybe it'll be 2%, right? Those are dramatic changes in the company, but we can adjust the growth rate up or down, maybe 0.5% or so, and see how that would ultimately affect the value of the company by changing that growth rate. In addition, we have a model that's called the earnings retention model. This uses the rate of return on equity for the firm. So the company retains some money and it earns a certain amount on that money. That is the ROE. So the ROE represents the earnings on retained earnings. So if you take ROE and you multiply it by the retained earnings that you have, that's 1 minus the dividend payout ratio. That is, again, is an estimate of growth. So let's see how that fits here. The company has been earning 15% on its equity, 15% ROE, and they've been paying out 62% of its earnings. 5 years ago, the company paid a dividend of $2.65, and currently the most recent dividend is $3.50. So what growth rates do we have? If you plug it in the worksheet, we have places to calculate the growth rate of future dividends. If you put in the dividend payout ratio and the ROE, the retention rate model says you should earn roughly a growth rate of 5.7%. When you put that in for the dividends, it's 5.72%. Now, I will tell you that these two numbers are rarely ever this close. They're this close because I made up the numbers. But typically, we're going to want to look at them and let's make sure that they make some sense, right? So if the retention rate, if it changed somehow and the answer was 15%, I mean, growth of 15% into infinity is really just not sustainable. So we need a number that makes sense. So if one of these numbers turns out to be out the lunch, is totally out the lunch, we might not want to use that number, use the other one. But if they're close together, within a percentage or two of each other, maybe we just want to take the average. Okay? So again, that's the end, if you will, of this particular dividend growth model. Now, we have a couple of more things to talk about. We need to talk about non-constant growth stocks, just as we talked about with free cash flow. And we also have to talk about what we refer to as multiplier models. That's coming up in the next video.